Good afternoon, everybody. Welcome to TraderMerlin Show. It is your Monday edition, which should be a pretty damn eventful this week, given all the economic data and some of the earnings announcements coming up, especially for those of you looking for that retail sector. Now, I'm going to do as I have been doing over the past couple months, which is starting off with a general broad topic, which is generally started by a question that was sent in from some of you, the viewers. You can always email me at TraderMerlin@gmail.com or put your comments down below any YouTube video, and I will find those, add them to the list, and we'll dive into that. Now, before I do get into the topic du jour, remember Ryan Watkins was on last week, and he is going to review live on air 2 trading plans. We'll review them beforehand, but we'll do the critique and commentary, kind of he and I, on 2 trading plans. Whoever sends them in, we're going to put them in a random drawing. Again, if you are going to send in your trading plan, make sure that you remove any personal account information. Don't want any of that stuff. But send it on into TraderMerlin@gmail.com, and I will put you in a hopper, draw your name out. Right now I've got about a dozen that have come in, and I have until Tuesday. I said I'd give you until Tuesday night, so you have until tomorrow night. If you don't have a trading plan, spend an hour or two, sit down and just map out what you think would be a good trading plan for yourself, and we'll see if we can form that into something that is a substantial working document that can help you in your trading quest. All right, let's start off with our listener question. This is from Ron. He says, does the recent string of layoffs spell the end of Twitter Meta? How do you trade it? Well, that leads into a pretty easy topic for me, which is, here come the layoffs. I love the graphic out here. No, I didn't make this graphic. Just grab it off the internet, but it's a perfect one as they're sweeping jobs away. Now, before we dive into all the string of layoffs that's been going on, of course, Twitter laying off over I think 50% of their workforce. Got to understand what this means first off. Number one, when a company does big layoffs like this, generally they're cutting cost. And, quite often during a bull market like we've had for the better part of the last 13 years, you have a lot of jobs that were created that A, may no longer be used anymore, or just aren't worth the money you're paying them. B, you grew too quickly, expanding into different departments, into different segments and new divisions in your company that might not be producing. And now as the economy slows down, it's the perfect opportunity for companies like Twitter, like Meta, like Zillow, like Peloton, Snapchat. I mean, the list is a very, very long list of companies that go, you know what? We need to start cutting costs because they see the writing on the wall. Certainly, Jerome Powell has laid it out there and been very clear that this is going to be a painful period for businesses. And I think they're probably doing the right thing and doing layoffs. Now, how do you trade it? Well, we'll get to that in just a second. But I did want to share this graphic with you that shows some of the more recent ones. I know it's kind of hard to read. Plus, I have a lot of people that listen to the podcast. And for those of you who do listen to the podcast, thank you so much for your support over the years. Tim, long-time listener, first-time caller, huh? Well, good to see you, Tim. If you know what happened with Twitter, obviously 50% of their workforce was laid off. Zillow laid off 5%. Peloton laid off 12% in October, but they also laid off 20% of their workforce going back into February. And you can see some other big companies here. Companies like DocuSign dropping 9%. Snapchat dropped 20% of their workforce. Lyft, that doesn't really matter. Let's go down the list here. What else we got? This Robinhood laying off 9%, Hyperloop laying off 50% of it. Seems to be a common number since Elon Musk loves 50%. Virgin Hyperloop laying off 50% of their workforce, and many, 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 many others. These are just a small sampling. The point is, this is going to be the current trend. And if we follow what happened with the unemployment data last Friday, I believe they were expecting it to go from 3.5 and move up to 3.6% unemployment rate, a slight tick up. Well, we went from 3.5 to 3.7, and now you're starting to see a lot more jobs. Now, when I say that Twitter laid off 50% of its workforce, it's like, oh my gosh, how many hundreds of thousands of people was that? It wasn't that many. Twitter only has 7,500 employees, so you're looking at roughly 3,700 people lost their jobs. What are some of the other big names out there? Meta. Now, Meta might be a bigger situation. As you saw the news recently, Meta is saying we're going to have significant layoffs, although Zuckerberg sounded like he tried to calm it, but some of the releasers are talking about significant layoffs for Meta. And Meta has 87,000 employees. That's a bit different than Twitter's measly 7,500. So you've got over 10 times more employees working at Meta or Facebook, and those layoffs could be fairly substantial. Bottom line is, at the beginning, it's actually normally good for these companies, right? You trim the fat right away, so all of a sudden your numbers start to look a little bit better. It tells shareholders, hey, we're taking actions to reduce our overhead costs and hopefully get earnings back to you, the shareholder. So shareholders like to see that. And let's look at some charts here. I'll run through the market indexes here in just a second. I will let's go to Meta, because they announced some layoffs. By the way, I am long Meta. I have I only have 10 call options on Meta, but doing okay with those. Here is the Meta chart. It was up 6.5% today on the news that they're going to start doing layoffs. And they haven't made any announcements here, as official, like, here's how many we're cutting. It's impending. It's almost like Elon Musk did a little bit, maybe a month or so ago. He says he's going to cut like half the jobs, and lo and behold, he did. So here you have a situation where Meta, just saying that they're going to start cutting jobs, caused a bit of a spike today, 6.53%. But I would expect layoffs to happen across the board. I would not expect it to be sheltered just to Meta, or let's bring up Twitter. No, well, you can't bring up Twitter because the stock's no longer there. I think you might see some in Amazon, which, again, I am long 80 call options on Amazon right now, so I actually think there's going to be a little bit of a pop to the upside here for Amazon. We'll wait and see if I'm right or wrong. I also think you'll see them from Microsoft, one of the biggest employers out there in the tech space, and they had a nice pop today, up 2.93%, which certainly helped the NASDAQ's final numbers. So a lot of it, I think, is just not necessarily a watershed moment. It's that moment where I think you're seeing the big names start to do layoffs. Now, before, you did have some other companies out there, but how many people know of the Mom Project or Substack or Masterclass, Bird, Subhuman, Cameo, all those companies doing big layoffs, but they're not the A-listers. Now we're starting to see, Twitter and Meta, and I'm pretty sure you start to see a lot of the other tech firms, which expanded dramatically. I mean, wow, it would not surprise me to see Zoom say they laid off 50% of their workforce, because, what's Zoom doing? All right, here's, oops, no, ZM. Here's Zoom. Oh, we're back to $79. Yeah, well, remember we talked about this being a great short. I think every guest that I had on was saying short Zoom, and that was when it was up right around $500. So now you're down at $79. Yeah, this is where you start making layoffs and making it easy for your shareholders to feel comfortable that you as executives are doing things to clean house, get that bad stuff out of there, and hopefully get the ship righted. So as far as is it good or bad for the company, I think it's very good for the company. It's actually a blessing in disguise for the Federal Reserve. And we'll talk about this here to Les's question in just a minute about the Fed and what their actions are as far as fighting inflation. But one great thing to help fight inflation is unemployment, right? When you have full employment like we've had, let me see if I can bring up your, unfortunately I don't have it all set up here. When you have full employment like we currently do, and I'll bring up your unemployment numbers from last week here real quick, you have everybody, well, a large percent of the population employed, and that, of course, means you have a lot of people that are earning money. Here's our unemployment rate, as I mentioned, went from 3.5. They expected to go 3.6, came out at 3.7. But here is your unemployment rate. It's at historic lows, and I'll use this slider and go all the way back to 2006. We're at pretty historic levels as far as how low we are on the unemployment rate, which means a lot of people are working. Now, granted, that's the U3 rate. We do know that the U6 rate is probably a better measure, but that's probably running at about 7% would be my guess on the U6. So this means that people have jobs and they're earning and they're spending. Now, there's other factors as to why inflation has run rampant, but when you start seeing unemployment tick up, that means less spending. This could be a big impact for the markets going forward, especially from an inflation perspective. If all of a sudden we see these layoffs really start to increase, and it does hit some of the major employers, right? Probably not going to see too many layoffs going on at McDonald's, even though they do more and more automation, but things like Microsoft and Google and Alphabet and Amazon might start to jump in the fray here and shed some of their workforce. Well, that means unemployment starts to rise, and that means that people have less money to spend, and we start to see more of a recessionary cycle. So that's a great, Jerome Powell's probably loving the fact that they're laying off people so that there's less spending and they can get inflation under control. Now, there's another graphic I wanted to show you, which is this one. So a lot of, we talk about layoffs and what's the impact for the economy. Obviously, it's the beginning of a potential cyclical problem, because the more people that are laid off, the more people are out there spending less money. If they're smart, right? They're going to spend less money, rein it in, and go into survival savings mode. Unfortunately, some people don't, and they keep using their credit cards, which is a kiss of death. But most likely, they're going to stop spending. When that lack of spending occurs, that usually impacts retail sales numbers, and that means that businesses might start to lay off even more, and then the vicious cycle starts to get a little bit steeper. So we're not there yet with that cycle, but we are seeing some interesting numbers with regards to savings and credit. So here is U.S. personal savings near historical bottoms. hopefully many of you are doing everything you can to save, not spend, but save money, because you don't know when you might lose your job or the next pandemic comes or whatever the case may be. Always be saving and growing your reserves. Well, I like this one. Unfortunately, it doesn't go back as far as I want. It only goes back into 2019. And you guys can see the red line there is credit card loans, right? The amount of money on credit cards, which has literally been a 45-degree slope going back to 2021 when it was under, let's see, credit card loans back in 2021, in Q4 of 2021, in April of 2021, was right around 640 billion. Now it's 926. So significantly higher with regards to credit card debt, which, is everybody knows here, is an absolute kiss of death. If you can't pay your bills, you should never have a credit card balance. You should pay it off in full every month. But the sad part here is the blue line, which is the mountain chart, you can see as a percentage of disposable income. Back in the pandemic peak there in April of 2020, 33.8% of savings during the pandemic. That's what the average U.S. personal savings rate was back then, meaning everybody was saving. Now it's 3.1. So you wonder what's been fueling these market rallies. Well, spending, right? We had savings, and a lot of people, including myself, would look into our accounts and think, hey, I've got a bunch of money there. I can afford to spend. And you start buying more and more stuff. Now, a lot of people feeling the pinch that their savings is running very low, right around 3.1%. For the average U.S. personal savings rate. To me, this is another factor that's not good from an economic stability perspective, because if people don't have savings in the bank, should they lose their jobs? Should you be one of that 3,700 people that worked at Twitter that just lost their job, or the 5% of Zillow's workforce, or the 32% of Peloton's workforce? Now you're looking at your savings account going, I need this as a crutch, right? This has to support me. This has to help me make it through the tough times. 3.1% is probably not going to do very much with regards to saving you for the long haul. So I thought I'd share that one. By the way, thanks to Scott McCormick. He actually sent me that chart. Said, this one's pretty scary, and I agree. I think that paints a very, very ugly picture for the average retail consumer in the United States. Now, these are just U.S. I don't know the international numbers at all, but I thought I would share that one because it's kind of scary. All right, let me real quickly read some comments. Speaking of Twitter, it seems Elon isn't really a fan of free speech. You knew that was going to happen, right? That's actually another question that came in. I generally don't like to talk politics, but someone asked me, does Elon Musk impact his comment today impact my voting? I'll get to that here in just a minute. Elon apparently asked some of the newly laid off employees to come back to work since they were critical to the organization, at least at the time being. Not sure if that's true. I'm not sure if he did. I heard that he's going to be needing some of those people back. And honestly, to cut 50% of your workforce, that's pretty steep. I think what he's doing, and if the stuff that I read about Elon Musk is, he's brutal as a boss. He is one of those guys, he expects you, if you're hired, it's not a 40-hour work week. He's expecting you to put in 60 to 80 hours per week. And it sounds like the culture at Twitter, per Jack Dorsey, was very free. You got your game rooms, you get to take all these days off and just relax and have fun. Where I think Elon Musk is not a relax and have fun kind of work environment. He's like, get your freaking job done or get your ass out of here, right? I think that's a much more militant approach, at least from the interviews I've seen with him. He doesn't really have any love for playing games or taking it easy. So what I think happened is, I think he's losing he's cutting off the main bulk of his workforce that he knows he can get back, but he's going to probably restructure their contracts and instill a different culture, would be my guess, right? Yeah. And that's the tough part, Gary. Is just Musk will have to find loyal employees. I know right now a lot of the employees are extremely bitter about it. However, let's say you had a job at Twitter and you were making a good six-figure salary, as I'm sure a lot of those people were, and you just lost your job, right? You're pissed off. You're probably like, okay, where do I go now? Now you have Elon Musk offering your job back. You're probably going to say yes. My guess is you're probably going to get a pay cut or understand that you're required to work a lot more. I'm not exactly sure what's going to go on there, but that would be my take. I already lost the job. Trading for a living now, living the dream. Good, believable. That's awesome. I'm sad that you lost the job, unless you lost it by choice. But I think that's the ultimate goal, right? Is to do this all on your own, right? To be consistent, which is, I know some of you guys probably hate hearing me always talk about the plan and structure and discipline and analysis and reviewing your trade plans and journaling, because if it's your business and this is what you want to do for a living, I think you'd agree with this, Tom, and Believable Direction, that it's a constant analysis of what you're doing. Yes, you have a strategy that's working, but it's like, how do I tweak this strategy? How do I make this better? What do I need to do to go from 1% rate of return to 1.1% and 1.2, whatever the case may be? It's always a work in progress. Tom's, I highly doubt that they need to bring back Twitter employees. I have stepped into a web property, two of them agencies stepped across. I think that, it really depends on what they're trying to do. My guess is Twitter was working on all sorts of different pieces that, like I say, trim the fat, didn't necessarily need to be there. But I think he probably chopped off a little bit more than he needed to. And who knows? This is a problem that we'll just sit back and watch the soap opera as it goes on. Personally, glad I'm not working at Twitter. All right. So the second part of this question, which came in, was how do you trade it? So I kind of felt that there's more layoffs coming. It just feels that way because the tech got so overvalued, so high as far as dragging the markets up. And then you started to hear about more layoffs as the economy starts to slow down. Just from my experience, normally that has a little bit of a pop in the market, which doesn't necessarily mean that this market's going to have a huge rally from here. But some of the ones that I just bought some calls on, Meta and Amazon, which are pretty risky for directional plays. Here is Meta. You look where Meta was just a few months ago, like to go a year ago, back in September of last year. Meta was trading at $381. Now it's at 96. Now certainly they have a ton of problems, but now they're going to start shedding some of the workforce. The question, let me ask you this one. Hey Chris, good to see you. I'm going to do a poll, which I think I can do. I'm going to do a poll here real quick. Maybe not. I get my poll button disappeared on me on this screen. That's kind of weird. Bear with me just a second to try to find this poll button. So I'm going to do a poll for you and see if we can have a little bit of fun. Well, the poll button is officially gone. So that's weird. Oh, there you go. Will Meta, can I even spell today? Close the gap at, let's call it 128. So I'm curious what you guys think about this. Will Meta close that gap at 128? Hopefully I wrote it out correctly. Yes. And there you can see the chart. I'm looking at it closing this gap. I'll move this line down to right here, right around 128, 129, somewhere in that ballpark. Do you think it's going to close that gap? Just curious. Now, I right now am putting myself in a monetary position for it. Basically, I'm long on Meta right now. Not a ton, but I've got 10 Meta calls that are, I believe, January or February, probably. Let's just say in the next 2 months, by the end of the year, right? And what would that be from a gain perspective? Good call there, Gary and Lisa. Yeah, really, like by when? Yeah, you're right. And that right now, from current levels, would have to be an increase of 33%. So to close it fully would be roughly a 33% gain. Dave's right. Most likely, yes, someday it'll close it. But if we give it till the end of the year, so you got 2 months. 2 months for it to make it. Good call. I should have put that in the very beginning, but I didn't have time to type it all. Stuff to type and talk and do all this administration stuff. So I'll leave that poll up there for a little bit. I'm going to just say, personally, I don't think it's going to close that gap. I don't think it's going to close it by the end of the year. Believable Direction, that's a good one. Closes the gap when Elon Musk submits an offer for 130. Yeah, I'm pretty sure he's going to cut back on his purchases right now. He went a little bit crazy on his Twitter purchase. But, do I think that we'll get there? No, I don't think we'll get to close the gap by the end of the year. Now, what I do think will happen is I do think you're going to come back and challenge the highs after the gap, which isn't that far away. But if this thing gets up to 102, I'll have some great gains on my call options. I believe that my call options are 110, and the only reason I did that is because of the cost. All right, no worries. Well, we got about a 50-50 poll result here. Let me click this one. I'll just end it. So we got about half and half. Interesting. Well, I hope that you're right. If it gets to 128 by the end of the year, this will be a great position for me. I have to be out of this by the third week of December because on calls that when I buy call options outright, I never hold them closer to 30 days to expiration. Always always get out before then. So I'm long on those calls. Man, if we got to 128 by that expiration, I'd be killing it on this one. I don't think we can determine the time. Yeah, I'm with you, JD. I agree. It was one of those just fun little polls, right, to see what's going on there with regards to expectation. But you look at the big picture here for Meta. You look at the trend. The trend was beautiful. I mean, this was a gorgeous downtrend. Lower lows, lower highs look great, and then that bad earnings, which really gapped it down. Now, did not buy the day they reported earnings, because that's usually a fool's errand, especially the last time that Meta did this. It just continued to drift down and down and down and down and down and down and down. So, this might be a much bigger downtrend, but you look at the overall percentage decline for Meta over the past few months. I mean, this is pretty significant. And yeah, their earnings have taken a bit of a hit, but from peak to trough here, Meta's down 77%. I mean, that is a massive, massive decline, and I don't think they're going away. Snapchat, I think, is going to disappear. I think Facebook is way too ingrained. We'll wait and see how those call options turn out, but that's part of the reason, as I thought this may have been overdone, and usually you get a little bit of a knee-jerk reaction. Plus, I was kind of expecting layoffs. After those bad announcements from Meta, you kind of expect there to be a round of layoffs. If we were still in a raging bull market, I wouldn't expect the layoffs, but because we're in a bear market, and we're seeing big companies start to miss more and more, layoffs are absolutely coming. And then the same thing for Amazon, right? Amazon going from its peak to, let's go to its low. Amazon, I think, I don't know. To me, Amazon is one of the juggernauts, and I would not bet against Amazon ever. Down 53% to those lows we saw last week, and just a slight move up. Actually, down today 0.49%, but just hugging those bottoms. All right. Let's see. I don't know. Let's see here. There's too many things going on. Let's see. Data storage for your web company. All right. Myself and 80 electricians have been working on Meta's K-Lab campus in Illinois. Do you think that will stop expansion? No. Yeah, I agree with Tom. The data storage is getting more and more critical. That's something you're not shedding. What they're cutting is, I think at Twitter, one of the things they cut was cryptocurrency integration, which I think is going to come to Twitter anyway. You look at Facebook, they cut the whole Libra program. So it's things that are speculative investments. Data storage, cloud computing, that is not speculative at all. That is the norm now, and I don't see them doing anything to get rid of that stuff. So Tim, I think you're probably in a fine spot. Maybe they slow down the scale at which they're expanding, but as consumers need more and more data, they're going to be right there building out more data centers for it. The big challenge I see for Facebook and Google and Amazon going forward with regards to data centers is the need and interest, as I mentioned on the Friday show, talking about decentralization, right? When that means that instead of using Facebook's data servers to store data, I may be able to do that locally or shared computing through a decentralized network like Golem or Render or someplace where I could do data storage off-site, not using a centralized entity. But that's a broader disruptive technology. But I don't see any issue with data storage or data for Facebook. Everyone needs the data. That's how they're making all their money. All right, so how would I trade it? Look, I think long-term, you have to look at the overall market. So Ron asked in that question, Twitter and Meta, does it spell the end? No, it does not. I think it's a survival tactic. If you are, this is a terrible analogy, but if you're on a life raft and you got too many people on there and things keep sinking, the boat just can't handle the weight, you throw something off, right? You get some weight off that ship so that it can float. And I think that's the attempt here by Twitter and Meta. Why? Oh, sorry guys. I shrunk my main screen. And all of a sudden, my buttons are off. They moved. So how would I trade it? Well, first off, I think what you're going to get for Meta is a small rally, right? I think you get a rally. It might get above this 102.50 and just start to slowly close the gap. I don't see it closing the gap because I think that overall the prevailing trend of our markets, and here's the S&P 500, I do still think that this downward blue line that I've drawn, I still think that that's in play. Now, I'm sure some of you are looking at this part of the chart right here, just that little morsel, and you're thinking to yourself, hey, you know what? It's making higher highs, higher lows. So this is a bullish trend. And It is. It absolutely is. But I think you have to look at that bigger picture, which is predominantly down. This is just a retracement in that supply level that we were talking about a week or so ago. And really, what happens once we get back up there? If we get to this 39.20 mark and break it, well, then we have to reevaluate, but we're still in a downtrend. I mean, I could draw trend lines on here per the Scott McCormick way. We'll do it to the tails just to get the precise numbers there. So this is actually not a downtrend. If you guys look at that take this guy out of here. The one's long gone. This top blue line I have, that is not really a trend line, because a trend line you need 2 points to make the line, and then you need a third point for confirmation. And unfortunately, we don't have that right now. We may get that here in a little bit, but not right now. So do you torture this chart and you move it like this and say, that's my trend? Either way, you can see that we have a long way to go before we break this major downtrend in the S&P 500. So my bias would be a small bounce in these companies making layoffs because of the benefit to the bottom line. But ultimately, it'll give way to the broader market, which, the rising tide floats all boats. In this case, the tide is going out. It's going to sink them all with it. So what it does, in my opinion, is it creates an opportunity in something like Meta. And I would say that if the market keeps drifting down and we get that downtrend intact and Meta keeps dropping, at some point when the market bottoms out, then Meta is going to be a great buy, but maybe not right now. So, long-winded answer to your question there, Ron. But, Merlin, since we are talking about tech, where do you see day trading in the next 5, 10, 15 years from now? You mean as the profession day trading? Look, day trading's been around long before it was created in the 90s, right? You look back to 1994 when Harvey Houtkin really became the SOE's bandit. 96, where he started getting legislation allowed us to use direct access trading. 98, those direct access trading rules changed and we can now direct our own order flow. That was the day trading boom, right? That created it. But that was retail. Bottom line is futures traders, the majority of them are day traders. So day trading will not change in the next 5, 10, 15, 20 years. It might evolve, and there might be new tools to trade, new markets to trade, like cryptocurrencies, leveraged digital assets, and things like that. But we will always have people like myself and many of you who are, hey, I want to trade short term. I don't trust this market. I don't trust the election. I don't trust my elected officials. I don't trust earnings. I don't trust CEOs. I don't trust anything. Why would I want to take some stuff home overnight, right? So I think that talking about anything on the technology for day trading. If regards to technology for day trading, I think you'll probably get more algorithms. I think you get probably more people writing code or trying to create programs to automate their day trading activity. I will just say this because I've seen it happen too often over the years. If someone is selling a software online or at a webinar or at a presentation that they say, look, you just got to deposit money, pay our software fee, and this thing will make money for you, run away. Run away, because usually that's a scam. If somebody is going to create a red light, green light system or a box trading system, black box, what they'll call it. If I'm let's say I'm a programmer, which I'm not, but let's just say I am. If I'm a coder and I find a strategy or system that I turn this thing on and I don't do anything, but the machine just sits there and makes money, do you think that I would sell it to anybody? I wouldn't sell it to anyone on earth. Not a single person. And if what I might do is I might actually go out and get people to trade more. I might go say, hey, if you give me $100,000, I'll find out what the rate of return is for this black box system, and I will say I will give you, a percentage of that rate of return. But I would never give the software to anybody. It's my goose that lays the golden egg. So if you ever see them online, you're not going to have a system that works for the long haul. Pick up a couple of those black box systems. Yep. Ugh. Sorry, unbelievable direction. But that's it. Unfortunately, and especially good salespeople, it's so easy for a master salesman to make you believe that this little red light, green light system is the golden egg. It's not. You guys all know that this is work. It's hard. So I think you'll get technology and tools that will help make trading easier, maybe a co-location of servers, et cetera, things like that. But I don't think that the industry will change. If I look at the last 20 plus years that I've been doing this, right? I got started day trading in 1998. So gosh, it's been 24 years. Some of the tools like level 2 screen has changed, but still the same methodologies, still the same risk management techniques. The way that I place orders might be slightly different, but it's just evolution, which is why I'm such a stickler for the plan and evaluation, because these markets are going to change and you have to change with it. My permabull friends, we've had several people on this program in the past that have been extreme permabulls and like, the market's always going to go up. Yeah, it is until it isn't. I mean, you're looking at a market right here that's not always going up, right? This is a huge pullback, and if you held that, you're giving back 20+% of your portfolio. Well, let's market time this thing and hopefully capitalize on some nice swings in it. All right, let's see what else I have here. Typically, you can cut 10, 20, 50% of the economy programmers and not miss a beat. If you cut electricians, yeah, don't cut the electricians. Let me go to this part right here. So how bad am I? I gotta end early here because I have to go check out a property. So bear with me and apologize for cutting out early. I think I can do that. All right. So Les, always ask great questions. And Les, thank you so much for your continued support and interactivity. I love it. He says, with inflation, it is usually the consumer spending too much, chasing goods and prices going up. The Fed will perform some measures and eventually unemployment goes up, but the people stop spending. Is it different this time? I'll finish the whole comment here because I do think that this time is slightly different. He says the government pumped more money into the economy, and let's just add central banks there too. This is the one that I think doesn't get enough attention. This was not the government's problem. It's partly their fault. Majority of it is central bankers. We had supply chain problems causing shortages, not too much consumer spending, consumers just continuing with their high rate of consumption. With the Fed pulling some money out of the economy and the supply chains are getting better, could that help reduce inflation, or do we need massive unemployment? I think that to help fix it quickly, you need unemployment. You have to have some pain in the system and reset it. So, the actions that the Fed's performing, that's designed to slow the economy down. I can't remember how many times I've said it, but when you are raising interest rates as aggressively as you are, it's a sign that things are too heated up. And this is number one, the Fed problem, because in 2009, they cut rates to zero and they held that there till 2015. That should not have happened. It should have started raising rates in about 2011 or 2012 when the economy was already starting to show significant improvement. So the Fed screwed us all by keeping rates so low. Now they started to raise in 2018, I believe, and then all of a sudden the economy started to look ugly. Boom, they cut it all the way back to zero again. So that's the big problem, is the Fed funds rate. Now we're on this super aggressive raise, and when that happens, what it generally translates to is business slowdown on a much bigger scale. And there is a lagging effect to all this, which I've mentioned many times in the past. When you raise rates 75 basis points, it doesn't just hit Microsoft's bottom line. It takes 9 to 12 months is the number I've usually heard. 6, 9, 12 months. It's not happening right away. It's going to take a while. So if you do that, and we've raised so much so fast that some of those rate increases have not even come close to touching the bottom line. So my brain's telling me that next quarter and the next quarter earnings are going to start to look worse and worse and worse, which means more layoffs, etc. And the Fed has already said that. So I think the writing is on the wall for a bigger slide. I just do. And I know some of you here think I'm wrong, and that's totally okay. As long as your plan is tailored to the way that you think the market's going to go, then that's fine. I think that the markets are definitely, not definitely, I think they're going to have a significant challenge moving up. Therefore, I think they're going to drift lower and lower. Now, if we keep getting these layoffs like I just showed you, and Twitter making some big ones, and Facebook going to be even bigger, if we get Microsoft or some other big companies like Amazon do layoffs, well, then we'll really be in a much more difficult spot. And more layoffs means less spending. And that could all happen so quick with the rising rates and high unemployment. That big swing could put us in a pretty bad recession spot. Does it go depression? I don't know. I don't know if it necessarily go depression, but I'll worry about that when we get there. Merlin, do you think we are currently in a housing market crash? I think we're in the beginnings of it, Eric. I think we're in the beginnings of it. It's funny when you look at something like IYR, which is a real estate ETF. Oops, IYR. How about my typing dyslexia today? This thing was already selling off back in January of this year, and it's been pretty aggressive. And we've gone from a high on IYR from 117. You hit a low down around 75. So I think that we are seeing that pullback in the housing market. I'm seeing more and more prices cut on homes. I can't remember the stat. Some of you may know this one. The lending underwriting is like frozen right now. I have a bunch of friends in the lending industry that are getting laid off left and right, which I was kind of surprised. You know, when that mortgage rate went from, again, a 30-year fixed rate mortgage at 2.75 or maybe in 2.5, now it's 7%. Yeah, I think that's real bad. I think it's real bad, and I do think that the housing market is headed for more downside. And primarily because the Fed is going to keep on raising rates. They've made that abundantly clear. If inflation gets super high and out of control, if unemployment gets super high and out of control, now all of a sudden the Fed's like, uh-oh, now which one's more important, inflation or the unemployment numbers? And I mentioned this, that they kind of backed themselves in a corner. I said that for the last 2 years that the Feds really put themselves in a corner because they're damned if they do and they're damned if they don't, right? If they try to fight inflation, they're going to have big unemployment, which we're starting to see. If they start to fight unemployment, we're going to have higher inflation. So it's like, what do we do? Yeah, exactly, Carlos. What do we do? Well, as traders, look, as traders and investors, you know, if the writing is on the wall so much that there's going to be downside movement and more pain, then I think you either go to cash or you start using options to hedge your positions or you start shorting the markets. You know, sell covered calls against, if you have any long positions, be selling covered calls that you know are probably going to expire worthless, but will now lower your dollar cost average. So if the market drops, let's say 5%, you may only lose 2% on your position because you sold options and collected premium. That's what I would be doing. You decided to become a scalper? You better be quick, Carlos. You better be real quick. You know, scalping is a very high speed type of trading activity. I mean, you need to be very quick with your order execution. I would say that for someone to be a scalper, you have to be a master of your trading platform. You got to be using hotkeys. You have to be so quick at executing and doing all these things. Be careful. Scalping is a challenging one for a lot of people. So, all right, let me. So hopefully I answered that one. I think this one time is slightly different just because the manipulation. If you went and ever see a presentation at Online Trading Academy, you know, Darren Komodo did a really good presentation where he called it the everything bubble. You have an equity market bubble, which is fueled by cheap, easy money, right? I think we'd all agree that when you look at this chart, I'll go to a monthly here of the S&P just so you can take a long look at this one. If you go to the monthly of the S&P, I mean, look where we started in 2000. This is because of cheap money. Huge market rally. So that's the bubble created by interest rates at zero, partially. Number two, it's a little bit different this time. The everything bubble is going to be because of the bond market bubble. And of course, you could look at the bond yields. Let's go back to our 10-year here. So here's your 10-year. And notice that 10-year was just getting pushed lower and 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 lower. Why? It's because Treasury was buying all the bonds. We're crushing yield. We're making sure that everybody had access to cheap money. So you had a bond market bubble. And then because the bonds were so cheap, your 30-year fixed rate mortgages were so cheap, and everybody was lending because banks had zero reserve requirements, you have a housing bubble. So I think it's the perfect storm, and I do think you'll see more downside movement. I've been waiting for this moment for a while. Darren used to do that in his market. I think it's a market timing overview or a preview. He used to do those sessions. Merlin, do you think you're going to get back to a crash like 2008 or worse? Well, I mean, if you look at 2008 in the S&P 500, we only fell 54%. 54%. That was from peak to bottom, right? Well, let's just real briefly check this out. And I already have it mapped out partially, but let's go 54%. So you guys can see I have the peak here. Off that, this is a 50% right there. And let's go to 54. So if we get the exact same, this is on snap mode, I apologize. If we get the exact same 54% decline, that puts the S&P roughly 2,200. Could we get there? What do you guys think? You think we can get there? And not saying by the end of the year. I'm saying, it's sometime next year, maybe even 2024. Do you think that we could get down here to these levels that, when you look at this colossal move, that's 54%. You're right here. I think it's highly possible, especially if everything crashes at once. You know, when you look back here at these historic moves back here, these yellow boxes, this first one is the 2000 bubble, that was 50%. You look at this one here, this is the 2008 bubble, well, that was 54%. And Tom, got my logarithmic scale, that was logarithmic on actually. So here's logarithmic on. Here is logarithmic off, which makes it even look more crazy. So I think we can get there. It's just what I would encourage you to do is not put all your eggs in that basket, right? If you feel the markets are declining, and I'm in that camp where I think the markets are declining, which is ironic because I've got a big position long right now. I'm expecting a little bounce, then I'll look to be going short again and riding more shorts to the south side and adding to that position as it goes, because I just think that's where we're headed. Let's see. Excellent, Les. Glad I answered that one. All right. I'm going to finish with this one, and I'll get to economic calendar, and then I'll wrap things up. So this question came in from Ellen. How does Elon's tweet today impact your trading and your voting? It does not. Look, tomorrow is the final day to vote. Anybody here who's an American who's over 18, you have, in my opinion, you have a right and a duty to go out there and vote. Now, I don't care who you vote for. You're going to vote for the people and the parties or individuals that you think are going to do the best job that fits what your needs are. And, I get this all the time that, what did one guy say? He said, I won't listen to your show anymore because you're a liberal Democrat from California. I was like, well, you're wrong. I'll vote for Republicans on different issues. I'll vote for Democrats on different issues. I vote for who is aligned with my personal belief systems, and I think it's going to do the best for the country. I don't hang my hat on a Democrat or Republican party. I think that's kind of stupid to do. I think you kind of alienate yourself a little bit if you label yourself specifically as something. It's the people that are going to represent me and what are their views, right? And they don't all share the same views. Some have the same basic core principles, but go out there and vote. Make sure, if you're one of those people that thinks that, it's a waste of time, it's all rigged, shame on you. Go and vote. There's a lot of really critical, even if it's not just for, the senators that are up for vote for the important political issues that are facing you and your city. So, no, Elon's tweet, and basically for those who may not know, he was basically saying to balance power, you should vote Republican because the Democrats have the presidency. There might be some truth to having that balance, checks and balances there, but I still am going to vote for the people that I think, regardless of their political party, represent my views and my belief systems about society, life in general, and how to make this world a better place and maybe make my country better. So no, it does not impact me at all. I think it's, I think it's kind of unfortunate that he's polarizing like that. And he's got a very political voice now, and I think that it could sway a lot of uninformed voters, certainly the younger generation who's not really, maybe not to be entrenched in politics. Now they're going to just write, oh, Elon said do this, I'm going to go do this. Now all of a sudden you're swaying the populace, but it is what it is. Just make sure you guys go out and vote. You have a duty, an obligation. Don't squander it. Go out there and vote today or tomorrow. You got a couple days left. So that's it for that one. And then I'll get Scott. Scott and Lisa had two good comments, but I gotta get out of here. So let me real quickly run through your economic calendar for tomorrow, everybody. You've got Disney, Northern Oil and Gas, Wynn Resorts. You have Occidental Petroleum, Lumentum, who I have no clue who that is, and Novavax reporting earnings tomorrow. So, the main one there on that list is going to be Disney, right? There's a lot of talk about Disney. Really in a potential world of hurt. Here's their chart right now. So this is the monthly still. Really since 2021, Disney's just been tanking. It's down 50% off its highs. So Mickey's not doing so well. Maybe Minnie's not going to get a nice vacation this year. But, it does feel like it's stabilized. It's not making new lows below 90, but it is not making new highs. So we'll have to wait and see what happens with their numbers tomorrow. I'll certainly share those on the show. And I think that is going to do it. Here's your economic calendar for tomorrow. If we look at this calendar here, you do have some big stuff for the U.S. Obviously, the elections is the big deal. You also have IBD tip economic optimism numbers, and that will do it for the U.S. Let's see. Pippins and Merlin said you don't like to talk about politics. Do you think if Trump gets nominated, he wins in 2024? Does it help with the markets? I think if he does, personally, I don't think he's going to run. I don't think he'll get elected. If anything, I think DeSantis has a better shot than Trump does, but who knows? That's all speculation. If you look at what happened when Trump won the election last time, all expectations and forecasts were that the markets were going to take an absolute dump, that they were going to absolutely crater, and they didn't. They soared from there. I don't know. I don't know which way it's going to happen. I think, personally, that if the Republicans were to win the election, I think the markets would have a nice relief rally. And I think it's just because so many people believe that the current problem is just because of the Democrats, which I don't believe that. I think it's a culmination of everything we talked about. It's Democrats to Republicans. It's also the Federal Reserve. So I think the economy will welcome a change, and then we could have a nice market rally. But we'll have to wait and see when that happens. No, who knows? Who knows? Bottom line is we just got to keep making trades, and hopefully it ends up putting money in our pocket. Merlin, if you look at the chart, can I predict a winner tomorrow? No, GD, I can't. I can't tell based off what's going to happen in the election tomorrow. But all right, everybody, that's going to do it for me. We're going to have Justin Krebs on the program tomorrow. I'm going to do a longer-term perspective on tomorrow's show. We'll be looking at retirement. We'll look at, and again, a lot of people having some issues with retirement right now. So we'll look at that on tomorrow's show. If you have questions for Justin Krebs or myself, put them down below any YouTube video. I was told by some algorithm thing that actually helps my search results, which, by the way, thank you so much for the congratulations, 5,000 followers. I thought it was kind of cool. We passed that on Friday, so thank you very much for those who have spread the word about this show. I really do appreciate it, and hopefully we'll get to 10,000 much, much faster. So thank you guys so much. Hopefully we'll see you with Justin Krebs tomorrow. If you guys have anything you want us to discuss, email me at TraderMerlin@gmail.com, which is on the screen, or underneath any YouTube video. Take care, everybody. I'll see you tomorrow.